Welcome to Market Matters, our markets podcast on making sense, the hub for JP Morgan Corporate and Investment Bank podcasts. In each episode of Market Matters, we discuss the latest news and trends shaping markets today.
Over the last 20 years, what we have seen is the ecosystem of quant managers has become much more diverse. 20 years ago, we were all doing very similar things, and that's what caused partially August 07. These days, between managers using kind of deep learning or dynamic weights like us or different types of modeling techniques, different frequencies, it is creating a much more diverse ecosystem. But nevertheless, that risk of crowding is always there and something that we definitely need to watch for.
Welcome back to part 2 of our discussion with Dr Amadeo Alentorn, Head of Systematic Equities at Jupiter Asset Management. So Amadeo, thank you again for being here.
Eloise, great to continue our conversation.
So can we move on now to the competitive landscape, the competitive dynamics going on? I mean, on the one hand, there are far more data sets now available to investors, which perhaps helps you differentiate yourselves. On the other hand, I know there are many, many players in the quant systematic investing space, and programming languages and backtesting tools are only getting easier to source off the shelf. So how do you think about the competitive landscape and the extent to which the techniques you're using are becoming commoditized?
I mean, when you are in this world of investing, it is always an arms race, right? The arms race for alpha, and this is not new. We've been running this race for 20 years as a team. Clearly, the availability of data is a positive thing for us, systematic managers. We're not just competing among ourselves, but we're also competing with fundamental discretionary managers. Even those teams are starting to also use more data in their decisions. So maybe the line is starting to blur between what is pure systematic, what is pure fundamental or discretionary investing. But look, the search for alpha is the industry we are in. Crowding is nothing new. I was involved with the strategy back in August 2007 when markets went through that environment where a lot of deleveraging. So, it's not something that we're facing now brand new because there's a lot of money in systematic strategies. It's always been there. The risk of overcrowding, the risk of ending up with a number of different strategies across the industry that are doing something similar. We're very actively looking at this when we're coming up with ideas. Again, that goes back to the hypothesis forming stage to say, okay, what is the risk of that idea increasing the crowdedness of our positions with other managers? Something interesting that we've looked at over time is the idea of short interest. Short interest is one of those very generic factors that are used out there as a way of picking stocks. But just to give you this as an example, if one uses short interest as a way of saying, okay, which stocks we're going to short, the ones that are more heavily shorted, that strategy actually makes money over time. Backtests would show, and academic research would show that. But what happens is that by using that as a factor, you would actually, by design, be building in crowdedness in your strategy. And when there's a deleveraging event, you will then suffer more than if you were not exposed to that. So we try to avoid those crowded positions rather than piling on those highly shorted names that for a while might do well as shorts, but then when you have a short squeeze, you have a very painful event. So crowdedness is something that we fully integrate as part of our research process, and as we explore new ideas, making sure that we don't increase the crowdedness and that we continue to have a diversified set of exposures as different as possible to all the strategies out there in the street.
And anecdotally, I would observe that the diversification in exposures among quant managers has actually increased over the years. You referred to 07 where crowdedness in certain factors like momentum was very high. We observe in our PB books that quant exposure to momentum is generally not that high. And there have been periods this year where it's been, certainly neutral. And I would assume that this is related to the fact that there are so many data sets out there and so many modeling techniques with different alpha time horizons that actually one can have quite a diversified strategy as a systematic manager relative to the rest of the street. Is that something you would observe?
Yeah, absolutely. I would totally agree with that point. Over the last 20 years, what we have seen is the ecosystem of quant managers has become much more diverse. 20 years ago, we were all doing very similar things, and that's what caused partially August 07. These days, as you say, between managers using deep learning or dynamic weights like us or different types of modeling techniques, different frequencies, it is creating a much more diverse ecosystem. But nevertheless, that risk of crowding is always there and something that we definitely need to watch for. We work very closely with our prime brokers as well to understand also how our positions are aligning or not to other positions out there. So that there's definitely a lot of focus on understanding that.
And also thinking about the emergence of the macro equity space and the cross-asset systematic space. And you were referring to the blurred line somewhat between the fundamental space and the systematic space. And all of this is potentially broadening the number of players in this space.
Yeah, and obviously we've seen innovations across maybe other asset classes, like how systematic strategies are now being deployed quite successfully within fixed income, for example, or systematic macro. So yeah, it's historically was more about equity markets, and everyone was systematic was apart from CTAs was mostly focused on liquid equities. And now there's definitely more asset classes to play with, and that again creates another source of diversification across the industry. So Eloise, you were talking about momentum, and that's actually interesting because when we look at our dynamic weighting scheme of styles, one aspect that the model has learned over time is that trend following or momentum obviously can be a profitable strategy over the long run. But as we all know, momentum goes to those very regular crashes, right? Those environments where stocks that were doing well for a while revert very strongly. We saw that in 2022, for example, with the bursting of the expensive growth bubble. So, I mean, that's actually one aspect that when we are looking at the history of markets, it's a pretty strong relationship that environments that are optimistic, but with a lot of uncertainty, like the environment we're going through now in markets, is one of those environments where ex ante, the probability of a momentum crash is actually quite high, because towards the end of a cycle, you do have trends playing out until they stop and then they come crashing down, right? Yeah. So managing things like momentum exposure, very important in this part of the cycle. And again, something that we are able to do thanks to the dynamic weighting scheme that we have developed.
Yeah, that makes sense. And do you think about market structure when you're developing your models? And the reason I say that is over the last 20 years that you've been developing your systematic engine, market participants have changed enormously. In the US, the retail investor has a greater share of volume, and that really went up post-COVID. And I'm just thinking the retail investor probably fuels the momentum boom. Do you factor that in, or do you consider that when you're looking at your models?
Yeah, so obviously microstructure is key, even though we tend to hold stocks, or the model tends to hold stocks between 3 to 6 months on average. There is a process of daily trading on a daily basis, adjusting the positions. And over the last 20 years, that has actually changed quite significantly. 20 years ago, we would be rebalancing our strategies once a month with a large amount of turnover. Over time, we then move from monthly rebalancing to weekly and eventually to daily. And, just like we changed the way we interact with markets over these 20 years, so have other market participants. So markets are complex adaptive systems that are constantly evolving. As you say, the makeup of market participants change. The way those market participants are interacting with the market changes, especially on the trading side. Very, very important when it comes to implementation. We spend a lot of time with our centralized dealing desk here at Jupiter, who provide us with a lot of insights on how best to trade the different markets on a global level. And especially developments such as what's happening now at the close, a lot of volume being pushed at the close. How can we better implement our trades in a way that minimizes market impact, very efficient use of liquidity? Because ultimately, even though we trade daily, it's about building up positions that then we will hold between 3 to 6 months on average. So it's about minimizing that market impact to get those exposures and then to hopefully crystallize those alphas.
Makes sense. So finally, can we turn to the future? What's next? I mean, you said that it's an arms race for alphas, so you must have to continuously innovate or at least hone your techniques. So what's on your pipeline when you look towards the coming months?
So we've got a very busy research agenda. Research for us is structured in three different ways. There's a number of research projects that we are doing here internally within the team. Then the centralized data science team that we have here at Jupiter are also an interesting source of ideas, of data sets, as well as technical skills to implement some of those data sets. And then we also have a very active academic program. So a number of us come from PhD backgrounds, and we have continued to be at the cutting edge of academic research across a number of different disciplines by establishing long-term relationships with a number of academic advisors from various universities. Some of those advisors we've been working with for the last 20 years, especially in more traditional disciplines such as accounting, econometrics, statistics. More recently, we have expanded the number of academic relationships and going into fields like artificial intelligence, machine learning, econophysics. Econophysics being a very exciting area for us. As you might know, econophysics is where one is using modeling techniques from the physics world to better model financial markets with more flexible models. In Finance 101 will tell you, okay, assuming that markets behave following a normal distribution, let's build some models. Well, we all know that markets are not normally behaved. You observe extreme events very frequently. Actually, that's what I did my PhD on, kind of option pricing with extreme value theory. So that was kind of my baptism of fire in terms of acknowledging how non-normally distributed markets are. So with econophysics, really, we can harness the flexibility of some of those modeling techniques that come from the physics world, designed for tackling problems in the real world, and then doing a better job or a more flexible job at understanding markets, understanding investor behavior, especially when it comes to modeling things like which groups of stocks co-moving together, clustering techniques, clustering methods, something that's been used very widely in a number of different disciplines, and that can be quite useful in better understanding how different stocks in equity markets are co-moving, which groups of stocks are moving more closely together and more differently than other groups of stocks. So it's a very dynamic and interesting problem to say what is the optimal number of groups that you want to bucket stocks in a way of optimizing that clustering efficiency, just to give you an example. So a very active research program. We started last year a new PhD program where King's College and Exeter University, we are sponsoring 2 PhD programs. So we've got individuals working on research projects for their PhD that we have designed. They will be working on them for the next 3 to 4 years, where we are co-supervising that PhD research alongside an academic counterpart. And therefore, we have a say on how those projects develop and hoping to get insights in projects that are maybe more blue sky, projects that would be too risky for one of us in the team to spend 3 or 4 years looking at. Maybe there is nothing to discover at the end, but we can explore those blue sky projects with this PhD program. New data sets, that's a permanent aspect of what we do, continuously looking at which new data sets we can look at to incorporate and to diversify our models. Lots of opportunities around incorporating text-based signals. We've already done a lot of work on that, but there's a lot of text out there that can be potentially useful in better understanding the outlook of stocks. And generally, just looking at alternative data sets in a way that help us to better understand markets, especially on the sentiment front. We can probably all agree that we're still in a very sentiment-driven market where sentiment plays a big role. A lot of that sentiment comes from behavioral biases. Markets continue to go through cycles of over-optimism, then over-pessimism, and trying to better understand the different market participants. You were talking about retail traders, how they are behaving. That's obviously a key aspect of understanding equity markets. How wealth managers or the more institutional side of the market is behaving can also be very important. something that we've spent a lot of time working on is the idea of flows. How flows in and out of equity markets can create very significant buying and selling pressures. This is maybe not a traditional data set, but more something that helps us to understand the behaviors of market participants. And especially when you see an environment where there's a lot of autocorrelation in behavior. We saw that in 2022. Why did we see that big growth, expensive growth sell-off? Well, because it was the selling pressure around that expensive growth trend created so much selling pressure that eventually there was capitulation. Similarly, why did we see that very sustained rally in profitable tech or AI-related names last year? Well, it was the opposite. It was buying pressure, a lot of investors believing that AI narrative, culminating in the coining of the Magnificent Seven kind of a theme. And narratives can be a very powerful tool in creating those bubbles in markets, right? Those cycles of over-optimism, over-pessimism. As humans, when faced with the complexity of financial markets, we all tend to oversimplify. And whether you're talking about the Magnificent Seven or the FANG stocks, who remembers now the FANGs? Or the granola stocks now in Europe. Those things keep coming up because it's a very attractive aspect, having a simple narrative that helps us to simplify the complexity of markets. The downside is then that creates significant departures of fundamental value at the stock level. So understanding all of those dynamics, capturing signals that help us to understand how those deviations from fundamental value occur are very useful tools that we can incorporate in our stock selection modeling. And that will continue to be an area of future research, expanding the set of signals that help us better understand that behavioral aspect of markets.
Thank you for going through all of those various future areas of research and your discussion around sentiment being such a major driver in markets today. It's so interesting, and it does remind me of the growth of the retail investor, but also the rise in thematics and the rise in terms such as the Magnificent Seven and the FANGs and the granolas, etc. And it reminds me of a conversation I had with Chris Andrew, our head of market structure, sitting here in London, around the risks of retail investor, institutional investor groupthink, that everyone's now looking at very similar sources of information. Of course, social media data is leveraged by the retail investor and also by many systematic investors. And is there a risk that we're all following the same themes, jumping on the same themes? And maybe it's fine because we're going through this major technological revolution in a way, and maybe these themes are really going to play out and therefore we can all be right. But maybe it's a risk. And so the idea that you're systematically tracking it absolutely makes sense.
Obviously, herding is another very well-known, understood behavioral bias, and that's what you're effectively describing. The fact that there is definitely herding in terms of thinking and behaving in equity markets. But there's always the temptation to say, is this time different? And if you think about the late 90s, there was very strong parallels in terms of how, at the time, the internet was going to revolutionize the economy. And eventually it did, but it has taken quite a few years. And obviously a lot of the investors that were betting on that earnings growth crystallizing in the short term were very disappointed. So it's not exactly the same right now. I mean, you do have companies that are exploiting profitably AI opportunities, but maybe it's more limited than the entire valuation of that ecosystem of AI. It will take, I think, a long time for a number of different sectors of the economy to really be able to embed in a useful way AI tools in a way that makes them more efficient, helps to increase earnings and efficiency. So we're very good history students as a team in terms of how we go back through time and looking at parallels, because as they say, market cycles don't repeat themselves, but they do chime. And in terms of what we're seeing through our models, definitely some parallels with the late 90s in terms of over-optimism around a new technology. Definitely some lessons to learn from those environments that could be relevant in navigating markets over the coming months and quarters.
Absolutely. Well, Amadeo, this has been such a fascinating discussion. I really think what you've developed over such a consistent long period of time as a team and as a tech platform is so impressive. The way you're incorporating so many different data sets, from the fundamentals to the technicals to the sentiment, which is so key today, and across all of those 7,000 stocks. And thank you so much for opening up and telling us about the processes that you're using today.
Eloise, it's been a pleasure. Thank you.
Thank you also to our listeners for tuning in to this bi-weekly podcast from our group. If you'd like to learn more about Amadeo's work and Jupiter Asset Management, then please do see the show notes. You can also see there a link to Amadeo's work on econophysics. Otherwise, if you have feedback or if you'd like to get in touch, then please do go to our website at jpmorgan.com/market-data-intelligence, where you can reach out via the Contact Us form. And with that, we'll close. Thank you.
Thanks for listening to Market Matters. If you've enjoyed this conversation, we hope you'll review, rate, and subscribe to JP Morgan's Making Sense to stay on top of the latest industry news and trends. Available on Apple Podcasts, Spotify, Google Podcasts, and YouTube. Reflect the views of JP Morgan Chase & Co. and its affiliates, together JP Morgan. They are not the product of a recommendation, advice, or an offer or a solicitation. It is intended for institutional and professional investors only and is not intended for retail investor use. It is provided for information purposes only. Referenced products and services in this podcast may not be suitable for you and may not be available in all jurisdictions. JP Morgan may make markets and trade as principal in securities and other asset classes and financial products that may have been discussed. For additional disclaimers and regulatory disclosures, please visit www.jpmorgan.com/disclosures/sales and trading disclaimer. For the avoidance of doubt, opinions expressed by any external speakers are the personal views of those speakers and do not represent the views of JP Morgan.